Okay, now presenting Angad Chadha with Urban Infrastructure Group Incorporated.
Great, thanks, Yvonne. Welcome, everybody. It's our great pleasure. I'm Angad Chadha with Urban Infrastructure Group. Our great pleasure to be here at the conference today. I'm going to take about 15 minutes and take folks through the slide deck here that we have prepared. Just to kick off, I thought I'd do just a quick summary on where we're coming from here in our company. We pour foundations and build foundations for the residential construction market in Ontario, Canada. We've been around 5 years, and we've grown the business incredibly well, as you'll see as I go through the presentation. But when you think about what urban infrastructure does right now, when you walk into a master plan community, new subdivision, we do subdivisions that are 100 to 1,000 units of new homes. We do everything you stand on. So all the concrete, all the porches, the steps, the basements, the garages, we do all that work, and we do all the subterranean drain work that takes the water sewer out to the municipal sewer main, which you can picture is right under your sidewalk. So that's what we do, and we do it in a country and in a province that is miles and miles, or kilometers and kilometers, I should say, behind in terms of housing supply. So that's the big picture, and just wanted you to understand that before we dig in. So macro, and I'll start from very wide macro and then come down to the specifics about our company that's recently publicly listed, and our specific financials as it pertains to UIG, the public company. But at the macro level, in Canada, and particularly in Ontario and the Greater Toronto Area, you cannot go a day without getting into your car, turning on the TV, turning on the radio, without hearing about the housing crisis. So much so that at the most recent federal budget, there were tens of billions of dollars that were put towards the Build Faster program for home construction, both for affordable housing and also just the general supply. So the finance minister called it turbocharging home construction. Her words, not mine. So the drivers that really power our business as we look forward to the next decade, probably multiple decades, the drivers that we're keeping an eye on right now are interest rates. Obviously, that's critical in the housing and housing starts and people's ability to get mortgages and get finances and first-time new home buyers. The growth in immigration is massive in Canada, in Ontario in particular. And as I said, the billions of dollars that are coming in from the government balance sheet to support this growth. So you can't go a day without hearing about these kind of drivers and seeing where this market's going. A little bit more of a drill down into Ontario in particular as against other provinces. So this slide, the histogram, the bar chart there, shows you how far behind Ontario and Alberta are, not just to the Canadian average in terms of the ratio of dwellings to citizens, but even in the G7 countries. And there's a whole collection of quotes here that are all referenced at the bottom of the slide from various pundits, whether they are in the financial analyst side or in construction or bank analysts, all talking about how big this opportunity is and how big this problem is. I'll look at one quote that's at the bottom in bold. Ontario is the worst offender among Canadian provinces when it comes to lack of sufficient housing stock. So that backdrop is there. Another quote that we have, again, on the macro theme, this is at a scale and pace not seen since the Second World War. So from our perspective, we've got all the tailwinds and the macroeconomic themes at our back. So we view the opportunity ahead for urban as an execution play. We have an opportunity to execute within that stream, that vector. And so we think that we've put together not only a great team going forward, but our track record in our prospectus over the last 5 years, you can see our growth in revenue, growth in profits, growth in scales in terms of the number of units that we've been producing over the last several years. A quick overview for us. I won't touch on everything here. I think the key points are, yes, we've gone public. We've raised a couple $1 million. We have a business here that is running at about our historical last year's fiscal was about $12.5 million in revenue. These are all numbers are Canadian, with an EBITDA of roughly $2.2 million. So that's public, that's online, that's in our prospectus. That's what we raised our capital off of. The other thing I would say is we are very tightly held right now from the perspective of a ton of skin in the game from the founder and CEO, founder, CEO, board. The founder, Gary Alves, is here. He's at the back of the room. So we have a very, very strong incentive and support from all the insiders that are in the company. We will develop the stock. We're trading in a range of between 18 million market cap to about 24. We've been trading about a month. We're not focused and worried about liquidity at the moment. This is our setting transaction. And now we're going to go out there and get to business, not just on our organic growth, which is the business I spoke about earlier, but also our M&A. So similar to the gentleman earlier, 3 sessions ago, talking about his acquisition strategy, we have a very similar one because we also have a fragmented market in the specialty contracting that we do. So we're going to be scaling 2 different ways, organically as well as through our M&A strategies. From a cap structure point of view, similar to Ternium, who's a colleague of ours and also a shareholder in Urban. Great presentation, Ralph. We have 104 million shares outstanding. It seems like that's the Canadian thing to do, 104 million shares outstanding. I don't know why. But again, we did also a reverse merge into a CPC, which most people here I think know. Basically, it's a mini SPAC. I like to think it's a bit better than a SPAC. So we reversed into that and raised the capital and began our listed life on TSX Venture Exchange, and we're moving forward from that base. Earlier, people talked about small cap companies, management. We feel we've got a very unique board and management team. Considering we're in infrastructure and construction, we have a good, healthy dose of that experience, but we also have some extremely senior financial and capital markets executives, given that a key part of our strategy is to use the listed platform to scale. I myself am formerly president of the Toronto Stock Exchange. I ran the TMX listings business and stock exchanges, put together what's now called the TSX Venture Exchange in 1999, and was a senior exec at TMX for about 21 years. So it's nice to see some of the similar familiar faces around. Gary Alves, who's the founder of the company, 25 years in the concrete and drain, water, sewer, main, very experienced and has ran multiple businesses. Our CFO, John Ross, is also a very senior CFO. He's CFO of IM Gold and several other major Canadian mining companies, senior mining companies. Right in the middle, in the lower level, I'll just mention Harold Wolkin is our chairman. He was chair of the capital pool company we vended into. Harold was the head of investment banking for BMO, Bank of Montreal, Nesbitt Burns in the late 80s and 90s. So a very strong group of business people in capital markets, probably more than you'd expect in a 25 million market cap company, but it just speaks to what our plan is and where we're trying to go. We have very big aspirations. And these board members, not only is it experience, it's really the Rolodex. So our customers are the developers, the big developers in the Toronto and surrounding areas. And it's a pretty small place, actually, when it comes to a massive market of developing houses. But it's a pretty small network of knowing who the the billionaires are that are running these big development companies. And so our board's been very helpful in helping us lay the groundwork for the future. So quickly, a bit of a drill down. I mentioned earlier, our focus is in concrete and drain right now. We will continue to diversify our construction business, but we will never get into building houses. We like sticking to the foundational level, and we like that for a number of different reasons, from a risk profile in business and cash flow perspective that I'll get into in a minute. For those of you that don't know the Southern Ontario area, yes, you have the Toronto core, of 5 or 6 million people in the GTA, but we tend to work in the suburbs around to the west and to the east and to the north. So a lot of the regions there that you see on the far right, you may not be familiar with, but these are all cities that range from, on the low side, 50,000 people to on the high side, 750,000 people. So as we see the influx of immigration coming in and people moving in, they typically come in and out, not in the downtown core. So that's a huge opportunity for us. How we've built our reputation is pretty simple. We have had, and Gary has had, a commitment to quality customer service, repeatability, consistency, and we do have very deep relationships with our builders, and those are exemplified, I guess, in the stats that we have above in the blue with our bid win rates, our repeat business. One of our largest customers, Mattamy Homes, that also develops in the U.S. We do a ton of business with them and have done upwards of eight or nine different developments for them. So we get called back to do this kind of work. And we think our developer customers are excited about our plans to scale because they are looking for providers in the infrastructure space that have the workforce, that have the crews that are available and are not fly-by-night contractors that are here today, gone tomorrow. So they're excited about that, excited about our transparency, excited about the fact that we now have more tools in our toolbox to be able to beef up our balance sheet. As I said, leaving the sort of macro and continuing down the narrowing down to the individual metrics around our business. Top right, you can see our revenue growth. Obviously, our 2024 year is forecasted right now. We have a September 30 year end, so we're halfway through 2024. You can see our builds or units. Those are houses. It's either detached homes or towns. Typically, that's what we do. So there's a mix there. So we did almost 800 units last year, and our pipeline is in excess of 1,100 this year. So we're continuing to push through that. The balance sheet is super clean. We have no debt. Similar to the gentleman who was speaking earlier about their acquisition strategy, we will take on a smart amount of debt as we look to do our first few acquisitions. We're an EBITDA positive company. We are only looking at businesses that are EBITDA positive, and most of the sellers in this industry are not levered either. So we will be using a smart amount of debt to get these acquisitions pulled off. But otherwise, from an operating perspective, the business is not leveraged. And one thing you might not realize, and I didn't realize when I got into this about a year ago, is that there's very little CapEx. And you think about construction and foundations, and you talk about rebar, and you talk about concrete and drain, you think, whoa, you must have a lot of it there. But the reality is, our CapEx is really the power travels that smooth out the concrete and cure it, and everything else gets shipped to site. So we get our gravel shipped to site, our pipe, and our concrete shipped to site by third parties. And from a cash flow perspective, we have 30 days to pay, and our developer customers pay us every 15 days from completion. So if we complete a third of the house, we get 15 days from there, we have direct deposit coming in. So as a result, we're always running working capital positive. We have no debt. We have a bank line for about $1 million with TD, Toronto Dominion Bank. that we've never drawn on. So we're in a very strong position, and I think that's one of the reasons our investors who participated in the going public round like the business. So a lot to like from a cash flow and from a balance sheet perspective. Just to double click a little bit on why we like this space, we call it stage one of the construction process. We like it because the phrase we use is FIFO. We're first in, first out. We don't really want to be around towards the drywall taping and the painting and the roofer. We're paid pretty quickly. We're in and we're out. And to put it bluntly, we're really not a service that once we get started, you as a customer can really mess around with. We have to get that job done. It's so foundational that typically we have very little in the way of credit concerns. And the customers we choose to work with, as I said earlier, are all large. So we're not doing custom homes in a neighborhood, 4 or 5 homes. We're doing 100 and up. So we're dealing with players that are far more established and are not going bankrupt tomorrow, kind of thing. So that's why we call it FIFO. And as the picture sort of shows you, it's really subterranean work. And this next slide just really reiterates that. But it shows you on the far left in the gray all the things in foundational infrastructure that we like. So we do all the horizontal work, as I said earlier, everything that's concrete and the foundation you can stand on. For an example of our first target acquisition that we're going after is the basement walls. So this is your low-rise forming. So that meets all the litmus tests that we like. It's FIFO, the business doesn't have debt, it gets paid on time, all those kinds of things. So that's sort of our first acquisition target that we're working on right now. So that's sort of the organic business. What I'll touch on now is fairly high level, but around our growth and why we chose a public platform to do this, because our vision is to build a large sort of multifaceted infrastructure company. We're not going to necessarily be kept to low-rise residential construction. There are other applications and other verticals that we are eyeing. But in this particular sleeve that we're looking at, which is like the floors, the concrete and drain, the low-rise forming, which are the walls, the water sewer main, which is the municipal part under the sidewalk, so to speak, all of these are run by businesses that have been operating for 20, 30, 40 years, and where the owner-manager is typically in the late 60s now, and kids are not interested in this business. They want to work at Facebook or Google. These businesses were started by newcomers, typically that came from Portugal or Italy in the 70s, and they have not had any real banking relationships, don't have exit plans or liquidity plans or succession plans. So where we come in is being able to offer them a solution, which is based on what we can leverage from the bank perspective of their EBITDA, but also tying them in and letting them participate in the stock. So they sort of, if you will, get pregnant on the overall platform, which is UIG, and we intend to scale that way as we go forward. Our deal structure is really around shared risk and locking up these founders and owner managers for a minimum 3-year period. What's unique, I think, about our performance structure, so the consideration that's conditional on performance going forward, is you would think we would focus only on top line, bottom line, your typical type of thing. First and foremost is labor. So if we buy the business and it's got, 7 crews, four each, so almost 30 people, that partner, we call them owner manager or vendor, seller of the business, is going to get hurt in the wallet. They're not going to get paid out. If a year or 2 in, we're losing foremen. Typically, the supervisors and foremen are where you focus. So those are key people on these job sites. And if you lose them, you're really losing your value. So when you go to your customers, the first thing they want to know is, how many crews do you have? So that's the one that's the sort of number one performance criteria. And then, of course, we do have the financial elements of their revenue and their EBITDA, et cetera. So it's a structured and a shared risk approach that we're taking. And we've really modeled this off of, what I've seen over the decades of the most successful public company roll-up deals that I've ever seen across TSX and venture. We're really looking at that, players like GFL and other sectors, and how they've managed to use the public vehicle properly and to scale. This slide here, I think, gives a good overview to leave you with how we think about what we can do going forward. The blue is everything we already have, and we've proven we can do. It's in our prospectus. The growth has been there. The revenues have been there. The profitability has been there. The left are the capabilities that we want to acquire, that we see out there, whether we acqui-hire them, whether we greenfield them, or whether we actually go out and do an acquisition or do a deal. And the right are some of the new verticals, just a few of where we think we can take our core capabilities. So as we acquire these capabilities, the blue in the middle gets bigger and stronger. And as we look out, one of the areas that we're having a lot of meetings on right now is the electrification, the grid, really, as you prepare for the world of EVs and cars, and you look at all the retrofits for gas stations, you look at quick serve restaurants that the big chains that they now want to have 3 or 4 level 3 charging stations next to their locations, because they've seen that the 7-minute increase per customer per visit in their restaurant, if the family's there because they're getting a discounted level 3 charge, it takes 27 minutes. So you'd say, what do you guys know about electrical charging vehicles? We don't, our partners do, but there's a big construction piece there, which is essentially concrete and drain. It's what we do. So we trench, we lay the pipe, run the conduit, backfill it, and then we have all the pads that are required for the electric heavy stuff, the batteries, et cetera, and then your charging station, each one. If you go to a gas station, you notice it's sitting on a concrete pad. So all that kind of work is just one example of another vertical we can get into. This slide here is really telling you a little bit about how our focus is on making sure we're governing the business very, very closely, measuring the right KPIs, particularly because we plan to be so acquisitive, and we're going to be rolling in other businesses that have been around for a while. We need them to come into our systems unless they've got a better system in the early days. But it's all the more reason to have a very structured approach from an operational perspective. So not just on the key performance indicators, but on our risk registers and things like that we have to keep our eyes on. So those are some of the things that we're really focused on, and we've got a lot in the pipeline. There's a huge backlog. I'd say that the most important thing that we're looking at right now is just interest rates. I know the U.S. held earlier, about an hour ago, they announced they held their rates. We are, I won't say anticipating, most of our sector, the developers right down to what we do, are sort of waiting with bated breath to see when we can get some language that suggests a cut's coming soon, because our developers, even though we have a lot of the contracts in our pipeline, they want to have their open houses on the weekend where they can pre-sell all of them. And if you get a half-point rate cut or quarter point, guess what? People start running their numbers and they start to say, okay, I'll get the mortgage pre-approval and be out this weekend to purchase and put down a deposit. And the pricing power goes back to developers too. Something they would list for $899 for a detached home, an hour outside of the city. They can maybe price it at $929.99. So they're waiting. So we're all sort of watching that. It's probably the number one thing in Canada that is going on right now in terms of interest rates. Won't go through the comp table in a lot of detail. Suffice to say that between the U.S. market and the Canadian market, I'd say there's 7 or 8 comparables. But the investable universe, certainly on TSX and TSX Venture, I can speak to having run that business for a couple of decades. There isn't a lot out there in this space. There's REITs, there's very big construction companies that are doing hydroelectric dams and power plants, but there isn't really a pure play on the residential housing sector in Canada and in Ontario that gives them access to this type of business. So We think, we went public at a very dark time in small cap and raised some money. And so we're pretty happy so far with the response. It's on us to continue to execute. And with that, I'll wrap up. Those are my formal comments, but would love to take questions now, and we're available tomorrow for one-on-ones. We got a pretty busy day, but we'll always make time. So thank you very much for listening. Thank you. Come on, everybody knows housing. A question? How to build one? I'll throw that to Gary if I get that question. Yes, sir.
So got the new your acquisition, the founders of the business for years, hopefully a milestone in order for the gain and so on. And you just straight forward from the 107. Those plan it well, yeah. Once the founders the 400 is working for public company, they're gonna get options, and that's what's gonna keep them in. Well, because they're not part of the big companies that the private, which is a different thing.
Yeah, great question. Great question. It's all of that. I mean, I think it's a testament to, I think, the culture that Gary has built in the business for a long time. Our crew, we have about 30 crew. Very much Gary's created a very family environment. We've been sponsoring people over that are family members of the crew that we have using the foreign worker program. But we are currently looking at our retention strategies, and certainly, like at every going public seminar you'll ever go to, they'll talk about, well, you can use your shares as currency and, options to retain staff. We will be doing that, particularly for the senior guys. So the foremen, we don't have any ladies yet. So I did say guys, but there could be construction ladies and foremen soon. We are doing that. So we have our plan approved. We went to shareholders and got that approved. And we'll be looking at that very closely. In addition to some other things that are out there, there are a couple of really cool retention and rewards companies that are out there that are focused on how do you have, in the construction space for outdoor crews, how do you incentivize, how do you retain them, and basically saying, listen, for every dollar you invest in this program, you get 3x or 4x. So we're looking at different ways to, treat the most important asset appropriately. And I think, I don't want to speak for everybody else, I think the general population doesn't think about the folks that are out there from 6 a.m. to 4 in the afternoon, working their tail off, whether it's super hot or it's super cold. It's a lot of hard work. So that is very much part of our strategy. So for sure. Getting a 5-minute warning here. Any other questions? I'll take NHL playoff hockey questions on the Stanley Cup odds if anyone wants to know. Oh, that's a layup. I think I'm going to have to go. This is recorded, right? I can't believe I'm saying this. I think it's going to be Vancouver, obviously. I hope I'm wrong, but I know the odds. If you walk down the hall and place a bet, if you pick the Leafs to win, put $100 down, you probably win $1 billion. It tells you something, but yeah, we'll see. All right. Oh, one here.
One of the graphs still does that.
Yeah, the question was, sorry, I didn't repeat the last question, but it was a Stanley Cup question. The question was, Alberta was also identified on, I think, slide 4. We don't have any current plans right now to do that. We have a lot of, wood to chop, so to speak, in Ontario, right in our backyard. That said, on our current business, it's highly mobile. Like some of the cities I talked about that we go to 2 hours away, it's not a problem because everything gets delivered to site. So I think for a flat forming, which is what we do right now, which is everything you stand on, we're very mobile. Like we could go to Calgary and still get everything delivered to site, put our crew up for a couple of weeks to, bang out a good chunk of a new subdivision. As we get into things like low-rise forming and water sewer main, some of those are a little bit more capital intensive. The low-rise forming is your walls, so you have actually the big forms that you've got to move around. You know, we don't have that in the low-rise forming. So I think yes, but it's going to be situation specific. Right now we got a lot in the pipeline just in the surrounding Toronto area. So yeah. All right. Well, thanks everyone. As I said, we're available for one-on-ones. Reach out to us. Our contact information is here. The rest of the team is here. Gary, Bill, Ralph, we're around. So thank you for taking the time.